rally today as a result. It just goes to speak that it's really all about positioning. It's really all about the way that funds are setting up and unwinding things ahead of these big reports. So just follow the price, don't follow the noise, and we will continue to make it through pretty well, given the fact that we have been on top of the sell-off since Wednesday. I hope you guys are doing well. Good morning, Carol. Good morning, Connie. Good morning, Paul. Hello, UK Ray Submariner and the rest of the crew. I know Eric in Northport's hanging out, but just watching the pre-market chop. We had a mixture of earnings reports came in last night. Amazon getting blown out in terms of the way the stock moved. Apple has held up a little bit. Abysmal jobs number. Okay, well, yep, but that doesn't matter because did this create a generational buying opportunity because they're going to have to cut rates in the future? That's kind of the way that this market operates. We will be watching price and we will be watching momentum, and that is one of the key things that we have to focus on today with our checklist, with our trouble trade news, and the move on the Russell in the last 48 hours. Yesterday, I walked you through a variety of different ways to short the Russell 2000 and talked a lot about how it was breaking under these key moving averages and how selling pressure had picked up. That has amplified this morning as we pushed almost down to the 50-day moving average. But once again, we'll dig a little bit into what's going on there. And then if we go broader, if we get into a situation where momentum really breaks down, and there is a reason that something happened in the last 48 hours that is very, very important to our overall momentum tracking. If it does break out, I want to show you the 6 rules and how to manage it. So once again, on a day like today, there's a lot of job report positioning. There's a lot of jockeying because of the Amazon report and the Apple earnings report. The exit liquidity, that will be you if you're not paying attention to us this morning, because this is going to move pretty wildly when the market opens. So is Amazon. Just because it is down on Amazon is down right now, what, 9%, 7%, does not mean it's going to finish the day at down 7%. There's going to be a lot of activity in the first 30 minutes of today. I know Don's going to be very active with that, but we're going to walk through the stocks that are worth engaging. We are letting you know right now that this can be one of those trap days where suddenly everybody starts selling and then out of nowhere, the way that the positioning is around options activity for today and other types of setups heading into Third Friday in 2 weeks, you could see a little bit of a surprise today. No matter how bad the news is, don't be shocked if all of a sudden we have a sell-off and then there's an opportunity to find a reversion. And we'll be paying attention to what smart money is doing. Now, on top of all of the key things, and I know we got a couple people still coming in right now around 8:50. Again, the big news today is from the macro perspective, the idea that we have these tariff troubles, right? Trump coming out of nowhere and dropping a massive tariff on Switzerland. Okay, that kind of came out of nowhere. But they've introduced new tariffs that would start on August 7th with minimum of 10%, up from the 39 to 41 on certain countries like Canada, Taiwan, Switzerland, India, Brazil, and Thailand. So naturally, everyone is panicking about that again. We're back where we were in April and March with all of the chatter around trade. And resultantly, you add in a jobs report like we've seen and weakness in consumer cyclicals, which we've discussed for the last 2 days as well. And you have this setup right now where the panic starts to ensue a bit. It was just a couple of days ago that we were talking about all-time highs and bullishness and rate cuts and everything that came with it. And then the narrative changed. And we saw the narrative change in the selling pressure in the Russell 2000 and now the selling pressure that is picking up on the bottom end of the S&P 500, which we'll talk about in a moment. But the other thing to pay very close attention to today, a lot of focus on the tariffs, that is impacting the cyclical side. And I spent a good portion of my afternoon yesterday walking our Tesla mastermind members through the weakness on the XLY, through the names that were likely to be weakening if this persisted. And now we've dropped under our 50-day EMA on the consumer cyclical side, and it's virtually game on for everything. And I do want to just have you keep a very close eye on this one, because last time that we had this breakdown in the XLY, Very important to point this out. Whether you're looking at the XLY, which is the S&P 500 consumer discretionary, or the RSPD, and this is a very important thing to watch, which is the weighted consumer discretionary ETF that treats everything in the ETF equally. Look at what happens when this starts to break down. You break under that 20, 50-day moving average on this side right here at the around February 21st, and pay attention to the XLY. You have that breakdown that happens right around February 21st. There was a stock that was doing very well, and it was called Nike. And right around February 21st, it was fine. But as cyclicals got pulled, Nike got pulled with it. It is a very large component of the XLY. And the XLY now under its 50-day, Nike still dropping just under its 20-day. This is going to likely test its 200-day moving average. And Nike could face a significant amount of pressure in the coming weeks if this persists due to the ongoing trade weakness. So people unwinding Nike from that big move up to 80. We've already seen a move of almost 10%. This can move very violently. So keep an eye on Nike. Keep an eye on that 20-day, the 20-day and that 200-day moving average, and anything between it. I could see a retest of that 50-day once again. People asking about AIG. I have no idea, but it certainly is on my radar, and it's something that I'm going to discuss in a moment. Finally, jobs in the Fed, obviously very important. This labor market, right? The way that you have a change in the labor market, well, that can impact the expectation for a rate cut. And as a result of that, markets suddenly out of nowhere get optimistic, and then we start to see this covering. And certainly enough, the narrative then becomes, well, yeah, it was they're going to have to cut rates, so that's got to be bullish for the markets, right? Ooh, it's a lot. It's just a lot because it changes every day and no one knows, and all you have to do is just follow price. All right. So once again, we do this every morning. It is 8:53. Welcome people coming in a little bit late. As we noted, the real weakness in the market is in the Russell 2000, the Russell 2000 reading that we had going negative this morning in the futures market, but it is this figure that we really need to be paying attention to, because this is the number of stocks down 5% on the month, 5% on the week, down on the month, certain beta level, and compared to the number of stocks that are breaking out, there is a lot of weakness in the S&P 500. Now, it is not really persisting at the top across the Magnificent Seven, because once again, the MAGS is holding above that key moving average. And that has been reflected in the strength and the crowding of those Magnificent Seven stocks like NVIDIA, Microsoft, Alphabet, Amazon, Tesla, which is weakening, Meta, and Apple. But it's the bottom half. It's the ones that are worth $100 billion, $200 billion. It all adds up because it represents outflows in the ETF, in the S&P 500 from a broader standpoint. So as we look at this, the thing that we have to look at when that figure goes negative is the FNGD. And the FNGD, which is that leveraged ETN that I talk about all the time, the first warning signal arrived, and that is that it has broke above its 20-day moving average. It does not mean anything yet, because this can just be a short-term flood tied around options, tied around repositioning, tied around this jobs report. But this is where I start to get a little bit cautious. If it breaks its 50-day moving average, then I'm moving to cash. But for right now, this has happened, and the two things to pay attention to on the FNGD, the two biggest volume days in the last 3 days, these last two of the last 3 days, the most volume since that market really bottomed out back in April during the trade crisis. So keep a very close eye on this. It will be very, very, very important just to monitor in the coming weeks. And if this continues to break higher, it creates a self-fulfilling mechanism that leads to more leverage, unwinding in the system, and this has to reset each day. So it requires new buying and new positioning on swaps against the against certain positions that can exacerbate, it appears to exacerbate some liquidity issues in the broader market. All right, so on the strength side, there actually still are some companies that are doing good, but pay very close attention because even those strong stocks in the utilities can start to break down a bit. Vistra is under some pressure this morning, but pay attention just in case there is some reversal possibility there. SITE, don't know what you do, a landscape company breaking out yesterday. That seems to be built around news on earnings. Got to pay very close attention and qualify anything that hits the screener when we get that data set. Vasta, I don't know what this does. Consumer defensive, chopping right at that line, the 200, the 50 and the 50 and the 20-day moving average. Hopefully, this will be picking a direction soon. And Estee Lauder has done very well in the face of challenges in the market, but it has been strong. But right now, keeping above the head above water, this could actually turn around pretty quickly and end up down around that $80 level if it is not careful. Hilton, weakness. And this is going to be anything that is really heavily tied to consumer spending in the wake of the Fed decision. The cyclicals have been breaking down. Hilton is breaking lower. As I keep noting, watch the RSI under 50, MFI under 50, break negative on the MACD, that histogram expanding, and the ADX just flipping recently. We want to pay very close attention to that ADX. If it gets back up into that 20 range, that is where we have really a weaker trend, a trend in the wrong direction. But I would be looking for most of these names in the cyclicals to at least start testing their 50-day moving averages in the next couple of days. And that includes Nike, pronounced by that continued weakness. This is one of those days where people just panic, and you want to take advantage of their panicking by taking what the market is giving you. We've talked about the regional banks. Don's been on top of this. He was first over on the wall on it. I was over the wall here. But regional banks, KRE breaking lower again. There's something going on. I don't know what it is. It could be tied to higher interest rates. It could be tied to a lack of borrowing. It could be tied, again, to consumer spending and whether or not they're actually going to be taking out loans. I do not know. But I do know that there's something was wrong with the regional banking space when the momentum broke, and now it has broken under its 50-day moving average. Zion, all those names in this space are showing persistent weakness. A move under the 50-day for Zion would likely set up a good trade between the 52.50 and the $50 put at whatever range you want to go out to, most likely into September. On top of this, paying close attention to the XLY. Once again, everything is in play with this consumer cyclicals because that is where the real weakness is, especially on the small cap side, small cap consumer stocks. But at the S&P 500 level, there's a lot more liquidity and a lot more opportunity to use options to take aim at the downside. I did get a question about this. Tim's going to always say that the banks are healthy no matter what I say to him. So basically, we haven't even talked about it. But that said, we want to pay very close attention to AIG. And I had a good conversation with Blake about this yesterday, in which he said, look, this is not 2008. There's no real significant default issue. And I said, no, I agree with that. I'm just noting that AIG is back down to levels that we haven't seen since the height of the trade crisis back in April. And typically what we do see out of AIG is that when it really does sell off, it is telling us that there is something wrong. And it has been this way going back to COVID, going back to the bond crisis in 2019, back to the China crisis in 2016. It's just a canary in the coal mine. And it's a reminder that when this goes, there typically does align with some other issue that may not be noticeable in the broader market. So it's just one of these things where, we might be at the start of something, or it could just be a short-term issue. And a good example of a short-term issue for the broader markets would have been back in September of last year, right after the AIG crisis transpired, or forgive me, the Nikkei crash happened. There was a period in September that the market sold off and it chopped around and dropped under both the 20 and the 50-day. And then suddenly it took back off. There have been rumors that there was coordination between the Bank of Japan, the People's Bank of China, the ECB, and the Federal Reserve. It's never been proven, but it's certainly appears that there was some level of accommodation and coordination to have allowed this market to bounce back and rebound. So what we start to do in this environment, particularly when it comes to the S&P now trickling around that 20-day moving average, which again, this is always one of those things where now you start to try to project and figure out how significant is this going to be? Is this just going to be a one-off, which could end today and lead us into next week with more positive data, more optimism if the U.S. Reaches agreements over the weekend, or if we're looking at a correction of 4 to 5%, or correction is the wrong term, sell off of 4 to 5%, or if we're looking at something more significant. We don't know. But the only thing that we can do is position ourselves and to take shots accordingly. Because again, this market has been in a straight up trajectory for 60 days, and profit taking and a narrative shift is transpiring right now. That said, with the IWM breaking down the way it is concerning. Typically, this is a precursor to something bigger and broader, particularly a broader momentum shift. And that's going to bring us to the point of our conversation today about how we want to be really monitoring this situation. And that's going to be with a pretty simple watch list. So I've talked about the FNGD, but be paying very close attention to the UVXY. I'm not telling you to trade the UVXY. I'm just simply noting that when this starts to move above some of these key moving averages, it can signal that there is something significantly wrong. So that next place that you're going to be paying a lot of attention to on the UVXY is around that $19 level. If we're breaking above that $19 level, I think that there's something more significant transpiring, and you can see that when we have broken above those levels, we have had some pretty violent moves on volatility. Just a signal, not a trade. On top of that, the SOXS, the semiconductor stocks had been the leader of this market for the better part of 50 days. Now the SOXL is pushing toward its 50-day moving average. This is the leveraged ETF around the semiconductor stocks. It represents leverage in it, and it represents all of the individual stocks. Well, if the SOXS, the inverse version, starts to break out as well, it's signaling problems somewhere in the system, and most likely deleveraging, unwinding of lots of fund positions all at once. The TZA is the leveraged bear ETF for the Russell 2000, and as you can see, it's starting to move. We had a 5% move this morning, and we'll be watching that 50-day moving average, because a move above that 50-day average could signal much more significant weakness in the Russell in the months ahead. And I believe that we were talking to Brandon yesterday, and I said, where do you think this can go? And he said, well, if there's a 5% move on the S&P 500, the move on the Russell would probably be somewhere in that 10% range. That takes us down here to around 203, 205 for the Russell. I just caught myself. I realized that I talk fast. There's a lot going on. I apologize. So let me slow it down and get extra close. All right. Yang, one last thing to pay attention to. And this is just China. This is the bearish on China. So all of those stocks that have been absolutely ripping and running on the China side, they're all potential shorts now. And that includes my good old friend Weibo, that I have used as a positive momentum stock. Well, as you can see, when Weibo breaks down, Weibo really breaks down. So Weibo, sorry, bud. Looks like you're going to be a short over the next couple of days as well. And anything that is tied to the Chinese internet stocks, that is CWeb, I believe, which is the bullish ETF for Chinese stocks. Yeah, that's breaking down as well. So all of them will be in focus. That is bearish right here for Chinese internet stocks that move under that 50-day moving average, move under the 50, almost a move under the 50 on the MFI, negative MACD. Not good. All right. Sorry, Mark. We're going to slow down. All right. I'm laughing too. It's a lot. It's very hard to do this when you're in a room with no producer and no one in your ear. I apologize, because it's legitimately so much you got to cover all at once, and you move around. So Again, slow it down. It's fine. We got it. Here's CWeb. This is the Chinese Internet Bull ETF, right? All right. Breaking down. You're moving under the 50. You're moving under the 20. You have a move down negative on the RSI. You have the MFI breaking down. You have the MACD breaking down. You have a break on the ADX. This is all bullish for inverse stocks. This is bearish for the internet stocks in China. It's bearish for BABA. It's bearish for anything linked to the tech revolution of China. JD breaking down. Okay, we'll go. Not trying to be tough. Just trying to keep moving. Make sure that I cover all of the bases. All right, 15 minutes. Very simple. All right. I'm going to walk you through this, and we're going to do this once. The FNGD is the inverse ETN of the S&P 500. Not the FANG. It really is, at the end of the day, all of the leverage unwinding in the S&P 500 when we have a significant financial event. So as you see this break above the 50-day moving average, that was our crisis in March. This was our crisis in April. This is our Nikkei crash. This is our China spasm. This was a period of time back in April of last year where there were concerns about the money market and taxes. This is when bonds went to 5%. This is the gilt crisis. Big crash in 2022. This is the largest hedge fund sell-off in 15 years. This is the onset of the 2022 crisis. And COVID's right here. Okay? When this breaks above its 20 and its 50-day moving average, there's something wrong in the plumbing of the financial system. It has nothing to do with earnings, nothing to do with the Fed, nothing to do with the president, nothing to do with any of this. At the end of the day, all of these events that happen are because there is a lack of capital to refinance existing debt in the financial system. That is it. There is no other argument. It has nothing to do with trade. I mean, trade can trigger it, but at the end of the day, all of these problems are because of capital inefficiency in the system. There is $300 trillion in debt globally, and there is only $180 trillion to refinance it. You do the math. When you raise interest rates, you impact that liquidity. When you change trade policies, you impact liquidity. When bond prices are altered, you impact liquidity. And when all of this is happening and you have these types of events, all of the leverage in the system unwinds very violently, very quickly. So as I've noted, you can take $100 million and you can lever that up into a $2.5 billion position in the next 10 days. It's not that complicated. All that is done through the money markets, or it is done through the repo markets. And not only do you lever up on U.S. Treasury bonds and try to turn a levered position on Treasury bonds into a 5 to 10% return, which is crazy, but that's what's done. But you also lever up on individual equities. And most of these funds are all in the same positions. And a lot of those positions are the Magnificent Seven stocks. That's why the S&P 500, when it falls the way it does, it's because the weight of the S&P 500, those stocks are all being unwound at the exact same time, over and over and over again, because there is massive levels of passive investment in these stocks. There is massive levels of funds chasing these stocks because they are tied to their benchmark. There are massive levels of leveraged funds levered up in these stocks because they're trying to magnify their gains using leverage. And then there's the retail traders who are constantly chasing the gains in these stocks. And this is 39% of the S&P 500. Okay, so it's not a flight to safety all the time. It really is a collapse in leverage and concerns about the plumbing in the financial system. So in the event that this breaks down, and in the event that our signal gets so negative that momentum does go negative, our momentum goes negative, you need to have a plan here. Okay, the first thing is cash is your best friend in this environment. If this happens, cash is your best friend in this environment. You are going to try your best to either focus on what do you not need. And I really stress this in this environment. If you're looking through your portfolio and you've got some junk stock or zombie stock or some weird thing that you bought because people said this was going to be the next X, Y, or Z, get rid of it. Sell it now or buy puts or get out of that position. Right? If this starts to break down, and then never re-enter that again. Never re-enter that again. If you bought something because somebody told you that you should buy it, now is the time to get rid of that, right? You want to protect capital where you can protect it. I'm not telling you to move to 100% cash, but I am telling you that right now, the stuff that you bought that is on spec, that is unprofitable, that stuff is going to get nuked in the event of a major negative momentum event. So this might be a fire drill, but it is a reminder that cash is your friend, and you want to use technical levels to prepare for reentry, which I'll walk you through momentarily. This will allow you to buy low and sell high, right? Liquidity is critical at this point, and that's why we move into the second part of this. There we go. Do not sell puts right now. Seriously, don't sell puts. If you are a person who likes to sell puts, I want you to understand something. This is how you turn a felony into how you turn a misdemeanor into a felony. Okay? Avoid selling puts when momentum goes negative. If momentum goes negative, on the Russell right now, it's negative. So I do not want to be selling puts on anything in the small cap space at this very moment, because this can break down very quickly. In addition, looking at the cyclicals, I'm not going to be selling puts on Nike or Tesla or any of these other names while broader capital flows are exiting. You want to take some of your profits if you're up. You want to reassess them if you're down. Selling can be indiscriminate, and you don't want to put yourself in a position where you're trying to chase a 20% gain with an 80% probability of profit, because those spreads that you're selling or those puts that you're selling, you will be on the hook for that. So it's a good time right now, particularly if you're up on puts that you have sold, to take some gains and preserve that cash. And don't expose yourself to anything else that may happen in the event that there is downside. Imagine a situation where you're selling a $45 put on a stock, and now all of a sudden the stock drops to 38 because of broader macroeconomic issues that you cannot address, that you cannot control. And when I talk about that momentum indicator every day, when it is green, it's green. And that's a good time to be doing those types of things, of looking to scalp where you can. But this right now, if this goes the way that it could, I want to point something out. The very first time that I ever did this, I made a phone call to a friend of mine. And I said, hey, I don't know what's going on, but our signal, and that was February 21st, went negative for the very first time. And he was running a fund that was market neutral, and he was selling a lot of volatility. You know where the story ends there. That fund lost $1 billion in 3 weeks. $1 billion in 3 weeks. So once again, selling in this environment, especially selling volatility, my God, this is a very dangerous time to do that. If you are a person who sells vol, it is time to go golfing for the better part of, 2 to 3 weeks. Shouldn't be selling vol in the first place, but you do you. Number 3, learn implied volatility rank. IVR, which we'll be talking about a little bit today, measures the company's implied volatility today versus the last year. So typically with IVR, and this goes back to the old tasty trade rules, IVR under 25, good opportunities for calls and puts that are cheap and consider buying. It's the IVR that is elevated over 30, particularly on the 52 week that you're looking for. It's just important to learn this now, not to try to take advantage of it unless you are trading intraday and looking for swing trades with volume weighted average price. But when we get into the period of weakness and you start to look for the period of time where there's going to be opportunity to step in and buy, implied volatility rank will be very important, because when we hit a short-term bottom or we hit a period where there's going to be accommodation and change and something signaling that the worst of whatever we're going through is over, you're going to want to find those high implied volatility stocks to then start to sell spreads on and then to sell premium on, because people are still out there thinking, oh, the worst isn't over yet. I'm going to pay a massive amount of money to try to short. And that's where you're going to benefit both from the market rebounding, but also the crush on that implied volatility as things start to dissipate. Selling credit spreads and negative momentum. Remember, if you're selling put spreads during positive momentum, selling credit spreads during negative momentum provides the exact type of benefits. So you'd be looking at vertical call spreads on high IVR stocks to the upside, and if profit if the stock stays flat or declines. Higher strike call protects against surprise rallies, obviously. And, this isn't my favorite thing in the world to do, but it certainly is a strategy that people, who have traditionally enjoyed selling put spreads, recognizing that when momentum is strong, it's a good time to sell put spreads on stocks you want to own. When momentum is red, it's a good opportunity to sell put spreads on stocks you don't want to own, because, again, you're looking for these names to continue to break down. It's an alternative to buying expensive puts. Look for oversold conditions. So I have said this multiple times. Markets tend to get oversold if there are 7 or 8 days of significant selling. And the one thing that we're always looking for is when the selling pressure that we're talking about, and we've discussed this back here. Sorry that I got to go all the way back up, but if we see an extreme breakdown over here where there is no buying pressure, that typically represents a period of time that we're probably going to see a short squeeze. And I go back to the negative momentum event that happened in February 21st last year, or earlier this year. On March 12th, I wrote an article and I said a short squeeze is coming. There were no buyers at that point. There was nothing breaking out, and sellers cannot sell into nothing. Otherwise, you get this type of move. So they just pull the brakes back, and selling pressure drops. You see some kind of short-term covering, and then all of a sudden there's a dump. I've written about this before. It is the same pattern over and over again. It's the exact same thing. I feel like I'm taking crazy pills. Sells off, no buying pressure, squeeze, complete capitulation drop. Insiders will buy. Stocks will break out to the upside once you get that accommodation. The key thing that we will be watching, if this continues to drop, is the move on insider buying. So insider buying has been extraordinarily weak, very weak, for the better part of a couple of months. Here's the insider buying to selling ratio. This is dollar for dollar. And as you could see, taking a look at earlier this year, that spike right there aligned with the rally that we had starting at the bottom in April. Same thing happened back here in December where it bottomed out. We have to pay very close attention to the insider buying moves in the next couple of days. If this 5-day moving average gets up here into this range, that is going to be a contrarian bid. And a continued move up here would signal that the ongoing sell-off that we're witnessing would be relatively short-lived. But doesn't mean anything yet. We're going to be very patient about that. In the event that the S&P 500 or the Russell move into oversold on the daily, and what I mean by this is relative strength index, which is a momentum oscillator, and the MFI, a momentum and volume, when these get down into oversold on both of these, it has typically led to a short-term pop or a reversal. So once again, you're looking for extraordinary weakness, selling to exhaust, and then to take advantage of that weakness. That repeatable pattern that I've talked about, it happened during the Nikkei crash, it happened during the gilt crisis, it happened during the 2022 sell-off, it happened during the Silicon Valley banking crash, and it happened obviously in April of this year. The final thing, as you get into that environment where you are oversold and where we start to see insiders buy, that's where you want to sell puts on the things you want to own. You want to be targeting the very things that you like for the very long term. Berkshire Hathaway B shares, for example. If this starts selling off and the market is now hitting a point where there doesn't seem to be any significant optimism, that's where I'm going to go down 10 to 15% on Berkshire and start selling spreads or selling puts, because I will be content to buy it at a lower level, because at that level, that's where Armageddon type scenario conversations start. And my full expectation is the Federal Reserve will have by then turned the money printer on, and we will have QE once again. Is it too early to buy SH? No. Actually, it's a pretty good time to buy SH. Just keep a tight stop right back at that 20-day moving average. Very simple. We just broke that 20. So very good question. All right. It is 9:21. I assure you that come Monday, it'll be all right. Come Monday. Oh, come on. You know it. I will slow it down. I apologize. I get really excited when momentum goes negative. So I'm always, because this is an opportunity to now actually line up myself, position myself, and get ready to buy. Because once again, accommodation will come, because that's what markets do. The markets are designed for accommodation and perpetual bailouts, and I want to take advantage of that. I hope you guys have a great day. Talk to you soon. See you later. See you on Monday. Market Masters 845. Cheers.